Hello, my name's Neil Young. I'm the Managing Director of ASX listed Elixir Energy. We're a gas company primarily focused these days on a very extensive gas resource in Queensland, Australia, fabulously located, next door neighbours doing plenty. We've just finished a very extensive year-long appraisal well program with highs and lows in it, but overall a significant amount of data gathered and now a point of keen interest in the discussions that we're having with potential farminees.
Neil, good to see you again. Been a while, and I've sort of been a little bit, I say highs and lows. That's a great phrase. But more recently, lows. Looks like the market said this thing's terminal. Is that the case?
I think the market did come to that sort of conclusion, and naturally we think incorrectly. And so I think the key reasons for that are to really emphasize that this is an unconventional play. And in Australia, the best plays recently have been conventional, traditional ones in the Perth Basin. And it's over a decade since the fabulous unconventional coal seam gas or coal bed methane plays in Queensland emerged. And in these plays, a single well does not kill a play. It informs what work will happen next for the acreage holders, ourselves, and others, as do the work that those other parties are doing. So this is the start of a journey. This is a massive play. The history in the US is that people drill wells, they experiment, they find things out, they crack the code, and then they end up drilling tens or hundreds of thousands of wells. And we're at the pointy end of that journey just now.
Right. So what went wrong? What most companies, they go for unconventional or conventional. You're going to go for the best target first. This is a deep well. It's an expensive well. This was presumably the best well that you targeted out of the gate. What went wrong?
So what went wrong was focused on the final flow rate. We flowed gas from this well at various stages, starting at the end of last year when we discovered a free-flowing zone. We, in the course of this calendar year, have flowed that zone again, got an excellent rate. We had some interruptions in the stimulation part of the program as equipment had to go to and fro to other much larger parties. We, a few months before the end, got an excellent rate. Then the well had to stew in its own juices, to use a non-technical term, for a while as equipment went backwards and forwards to our neighbour Shell. When it finally came to us, the well flowed at a lesser rate, but still an okay rate. And we've concluded that was likely for various reasons that are operational in nature rather than intrinsic to the geology, and hence all ultimately remediable in future wells. But clearly the market goes, well, hey, that's Neil saying that. The rate's disappointing. We're retail investors. We're going on to invest in gold. But we think that the large players in the industry will see the quality and quantum of the data that's been gathered, the de-risking that's taken place, and the fundamentals are that we now own a very large resource package in a fabulous location.
Okay, a lot of things there to talk about. Okay, let's start with why is equipment moving backwards and forwards? Why can't you secure it for the period that you need it for? Because that's going to only, moving parts usually increase chances of risk. And in this case, that was borne out to be true. So why did this equipment move back and forward?
So I think the reality is at this early stage, there are only limited pieces of equipment that can do the job that we and our neighbours are wanting to be done. We're working at depths of 4,300 meters and above. We're working in significant overpressure, which is a great thing in terms of what it delivers in terms of ultimate recovery, but means more operational challenges in terms of what equipment can handle it. So there's only a few rigs can do this. Even more limiting, a coiled tubing unit, there's only one in Australia that can do this job. We had to import one from New Zealand in cooperation with our neighbours, and that has to go back to New Zealand shortly. Now, one of our neighbours is Shell, and they are rather larger than us at this stage anyway, and they tend to therefore dominate discussions with service providers. They pay more, and we have to fit in with what they're doing. But to go to the positive side, as these plays unlock, equipment floods in, new service capability floods in, and the CSG revolution in Queensland saw that with a handful of rigs turning into hundreds of rigs. And we're already having discussions with large American rig companies who can see the potential. So we think that this is one of those problems that solves itself with progress and de-risking, in that more and more equipment comes in. We see the start of that. And then also, if we bring in the large partner that we aim to do, that large partner has significantly better negotiating power and clout than us in addressing those issues with the growing service sector.
Right, and okay, I'm trying to get this in a sequence here. Like I say, I want to give you the chance to do objection handling, of course, but I also want to be clear about what are and are not red flags. So when you say when it flowed again, it flowed at a lesser rate, which is, you can tell me whether that's normal or not. And it was okay, was your phrase. Okay, meaning what? At least it flowed?
So we flowed at a rate prior to this happening at 2.5 million cubic feet a day, which in the high gas price environment that we face, that's basically economic. When we came back, it flowed at about 1 million a day, which is sub-economic. And we concluded that was caused by skin damage to the formation around the wellbore, which was likely induced by a number of different factors. Water and condensate banking, possibly, fine migration, possibly, or some mineralogical reaction to fluid in the wellbore. And we think that might have happened to the first well of one of our neighbors as well, although they're the sort of big company that doesn't really tell the world about that. So all of these things are remediable by doing things more quickly, doing things in a different fashion, and as you rightly said, not leaving things to stew and have them interrupted. So we are confident that if we had to drill exactly the same well tomorrow without interruptions, we would get a commercial flow rate and above. But we wouldn't necessarily just go and copy the same well. We want to learn new things. We think we've already learned that from this one. So we're currently considering a number of factors with respect to our next well, in terms of location, in terms of potentially moving from vertical to deviated or horizontal. And we'll also be informed in that decision-making by the work that the neighbours are doing, which I say is replicable across a large unconventional play like this.
Okay, and I want to talk about the sunk cost here, literally. Where can you tell us about how that well was, one, selected, two, how did you drill it? Was it entirely vertical? Was it slightly horizontal? Well, not horizontal yet. Tell me about that aspect of it. And is this just a case of we've got some data, but we've got to move on now, and we'll be drilling a new well somewhere else off the back of that data? Is there anything that's recuperable other than just the data?
So the well has been cased and suspended. It can be a future producer. I mean, as you said, the costs are sunk, but if they are sunk, we can flow. And at gas prices in Australia of at least $12 Australian a gigajoule, you don't need much flow rate to get a pretty decent dollar income per day. Now, there's not currently a connection to the market, but there could be in the future. So this well still has intrinsic value. It was an expensive well, but we managed to procure R&D support from the Australian government, which effectively has paid or is paying in cash for half the cost of this well. So today,
which was what?
We announced that the government paid us $8 million in connection with that, in cash. So that means that the high cost was carried, if I can call it that way, by the generous Australian taxpayer, of which I'm one, and this is a better use of the money than many other things. So that was a boon from this. To go back to your question, this was a straight vertical well. It was stimulated in 6 different zones. We therefore managed to learn more about each of those zones, and if we picked just one of them to go into, the future well decisions that we will make will be informed, obviously, by what our prospective partner wants to do, as well as by what we are thinking. So we're really in the game now of creating options for them and for us for that next well decision.
Do you need a partner to be able to move on to advance?
We don't need a partner under Queensland law. We've now met all commitments under this license. We're applying for a retention license. which gives in effect 15-year tenure with minimal work commitments in it. So we hold that like some valuable treasure, given its fabulous location, that we can deal with it if we want to. Now, clearly, we do want to, but only in circumstances which are beneficial to the company and its shareholders. Now, we're highly confident that this is an attractive asset for farminees. We don't have to rush to a decision with them, given that security of tenure, but obviously we're working on that, so recognizing that the pace by which big companies make decisions is significantly slower than it is for smaller companies.
Right. So that tenure is predicated on the fact that you have spent money as you should have. Is there any aspect of the extended license needing you to demonstrate that you've got money to spend in the future? Or is that just
no? The key aspects are to show that you've discovered an extensive resource that covers the license, which as an unconventional resource it does, and that it's not yet commercial for various reasons, and that those criteria allow you to secure that 15-year tenure. And interestingly, both our neighbours to the west and the east have already gone through that process with the relevant regulator. So it's a pretty sort of well-hoed paddock to follow there.
But they've got big balance sheets, right? But for you guys as a junior sub-$100 million company, it's been a tough few years. Do they just assume that you're going to be able to get this funded or find a partner or et cetera, et cetera? There's no need to demonstrate the ability to have cash in the bank today.
No, the rules are fairly prescriptive, and there's no requirement for that. It is to tick off the other boxes that I mentioned. And interestingly, one of our peers is in fact similar to us in size, although it's got some very deep-pocketed and very smart shareholders, which I think is an endorsement of the play.
Okay, let's look at the options available to you, because I think obviously that was an expensive hole. You're saying we've got some data from that which is valuable. Valuable to who? Because for you, you're going to have to go and raise some money to be able to, go off and do this yourself, or as you say, potentially let's get a JV partner in now and use their balance sheets at an asset level to advance, the potential here in the Taroom Trough. How are you going to play it?
So I think we've got a range of options here that I would highlight as being seek a farminee, which we're actively doing, who will pay for a good part of a program going forward, one. But two, and I think far more importantly, the mere fact of their entry shows significant de-risking of the play. So it's not so much the value of what they pay, it's the de-risking that they deliver. Our second alternative is that smart companies who are maybe a bit smaller than the big ones would see acquisition opportunities. So consolidation of small and mid-sized companies is ongoing, typically in resources sectors, and could occur here. The third option, and it's not a bad one, is that we have data, sure, but that data is attached to an asset, which is 100% owned, great location, large, and it's the combination of those two things that provide the intrinsic value to the shareholder, from which the other activities can be explored from a position of relative strength.
Can we get into that a little bit about what the different types of JV partners tell you? Because it's great that someone says, I've looked at the data and let's put a JV together. Let's get those terms agreed. If it's Shell, it's the sort of money we're talking about. The quantum is neither here nor there. It's pocket change for them relatively. It's a kind of, and they've got many of these bets all around the world. If it's a smaller entity, they need to believe, and I think in a funny way, they haven't got as good a balance sheet, but therefore it's higher risk for them. So therefore the decision making is much more considered. So, do you agree with that in some way, shape, or form, or does that inform your selection process, or is it a case of crikey, anyone will do?
Well, I think that for the ultimate developer of this play, the amount of money to be deployed is in the billions. I mean, there are hundreds of wells which cost tens of millions of dollars each. And so that's only a handful of people that can play that game in terms of money and in terms of expertise. Those players, many of them are in Queensland and own existing liquefaction capacity with growing spare knowledge in it. Of the mid-sized players, I would see really two camps. Well, firstly, there are people called mid-size who are still very big, and they are American tight gas specialists who drill unconventional wells like this, hundreds of times a year. And those companies typically have stayed in America, but we see that they do go other places from time to time. And this play is lower risk for them and with more upside than many in tougher locations. So those parties can see themselves as being the ultimate developers too, and they can deploy billions. Once we get smaller and companies only have a handful of billions on their balance sheet, they are, as you say, will be more judicious. And their strategy, in my view, would not be to be the ultimate long-term developer of this play, but rather to be the interim owner between us as the plucky explorer and an appraisal guy who's gone in, and the bigger guy who will inevitably come in, as I've described, and that they can see themselves adding value on that part of the de-risking curve, rather than being deploying billions in it themselves. So the ecosystem in resources, there's big fish, small fish, large fish, sharks and whales, and they all tend to have their particular source of value at particular stages of the cycle. Now, we think the big guys can come in at this stage of the cycle, particularly because Shell's already in. That gives significant career de-risking to peers in other big companies. But the medium-sized companies might well see merit more in a corporate transaction than an asset transaction. They can use paper in that rather than cash, particularly if they're listed on the same exchange. So again, people have different things to pay and different imperatives and strategies to follow.
Okay, so what are the things, if you're pointing to any aspect of this, when your shareholders obviously have reacted as they have, the share price has been hit accordingly. Their view is, daydreams turned into a nightmare. But what are you doing to protect them and continue a meaningful growth story? I think you've been quoted as saying that this will accelerate talks with potential partners. Is that going to be the way out of this, or is there more that you can do?
Well, certainly that is a primary but not sole focus. I mean, we are looking at some other things, some of which we can allude to, some of which we can't, and because they might not come off. Now, for instance, we acquired new acreage in a gazelle round from the government earlier this year. We've been adding resources into that part of that acreage, which is part of our overall Taroom Trough Grandis play. But there's another part of that acreage which is conventional in nature. We believe that it is ripe for a different type of farmer to come in, given its much lower cost. And we are in discussions about that. And nothing's done until it's done. But we do have a track record of closing deals with parties big and small. And we are optimistic that we will continue to add value through that deal-making capability, underpinned by a strong technical team that we have for a company of our size. So there is news to come. We're not just sitting and waiting for the big prize, and we do have options there.
Right. And these potential JV partners are they encouraged by the state of the market there in that part of the world? Because you've talked to me in the past about the Brisbane market, or that whole East Coast market. Are the prices there? Is the demand there? Are people willing to add to the current infrastructure? What's the future look like in this space?
Yeah, so the pricing is strong and expected to be enduring from all independent third parties who assess that market. It's currently 12, 15 Australian dollars a gigajoule, which if I compare that to the States, there's about $2 US, about $3 Aussie. So we are about 4 times higher priced market than that. Now, the States is the best market in the world, admittedly, and the space to put gas into that market is large. The traditional sources of supply are in rapid and terminal decline, and again, that's recognized widely. And there's expected to be shortfalls even within the next year or so, and that's being met by LNG imports, one project which has been FID'd and a couple of others which are maturing. Now, if gas comes in by boat, which we strongly believe it will, that's priced at $20 a gigajoule. So again, there's a very strong price signal from that. In addition to that domestic market, and that gap is wide. It's not just supplying a few petajoules here and there, it's supplying ultimately hundreds of petajoules within a short time frame. That's supplemented by the LNG plants in Queensland. Now there's 6 of them. They've never operated at full capacity. Their current sources of feedstock are peaking, and the combination of a strong domestic and international market is what will attract that broad range of large pharmacies in the discussions that I've described.
Right. And how do you kind of, maybe asking the same question but in a different way, but how do you capture any future potential value, again, for your shareholders?
I suppose we can't capture all the value. That's the nature of the food chain that I've described earlier. Clearly, we can optimize that value by inducing competition. So if I'm negotiating with a large party, they're not negotiating with me. They're negotiating with what they perceive their peers might be doing. So it's not bilateral in that sense. Now, if I'm right in my thesis that this is a very attractive play for those large parties, when they come in, they're not going to screw Elixir down to the last dollar, because if they do, they risk one of their peers coming in and beating them. And so that's the competitive dynamic that we face there. And it's really quite a good one. The big companies do have a strong position because they do recognize what I said earlier, that what they pay in terms of money is one thing, but what is more important is the credibility that their presence actually adds to their junior partners. And they know that's valuable, and they extract value from it, and so they should.
Okay, and again, sort of go back over old ground, but with regards to this data, let's be really clear why that's attractive to a potential JV partner. And, like you say, limited hands here. So what precisely are you going to be able to demonstrate or show them which says there's something here? This is the first innings out of many, first hole out of many, but we've demonstrated potential. What's that actually look like?
So what we say is we've got 240,000 acres held in the long term. We've drilled one hole into that. It's an appraisal well, and there are many more appraisal wells that can be done. We've encountered a 600-meter thick Permian gas-bearing section. We've flowed 5 separate zones in that, sandstones and coals. We've encountered something that no one's ever expected before, a free-flowing zone, and maybe that's small or maybe it's big. This is the start of the journey of evaluating that. Well, what we would present to, for instance, an American company, just to use an example, who's highly experienced in drilling horizontal wells, they'll say, okay, you've presented 6 different horizons that I can drill horizontally into. I can pick whichever one I think is best, and that can vary from location to location. And indeed, I might ultimately drill into a number of horizontal horizons from the same wellbore or same pad. That they will bring an enormous amount of American IP to that sort of decision making. And so that data gathering presents options, and it is options that people value here. And those options we're supplementing by, for instance, engaging with a very substantial downstream infrastructure company under an early stage MOU structure just now to look at gathering systems, processing plants. Ultimately, we see in cooperation with the government and with our neighbours to optimize CapEx expenditure there. So again, it's all about option creation, and that's what we think parties will value.
Okay, so you referenced something there, which I think is kind of interesting. When you've got these sort of layers of different types of sandstone and coal, etc., and repeat pattern, you talked about free-flowing gas. So I assume, therefore, that the expectation is with some stimulation, US technology, etc., this may be able to flow better, in which case, I come back to this whole, is this something that people, you said they will kind of consider kind of maybe going back in and sort of saying, once they've kind of worked out how to manage the fields better, you think there's some value, and there'll be some perceived value by maybe a larger JV partner. Is that right?
Yeah, no, exactly. People try different things through trial and error and to crack the code in a play. And, it's very rare to crack the code in the first handful of wells. And if I add up what British Gas, now more recently Shell, ourselves, and our peer Omega done, there's still there's still less than 10 wells in this play, and ultimately it'll take thousands. And the cracking of the code isn't just done instantly. The productivity improvements that have occurred in the US tight gas plays have just been enormous and consistent, not just do it right and then just copy it. You learn all the time as you go. So what we see, therefore, to come back to my point, is it's only the resource in the right location which is valuable, and then other people will build upon the IP that the early parties develop. And that IP is not location specific; it's more play specific, which is over and beyond the particular license area that we've got. So I think that those are the key points that we see there from that data acquisition and what that means to those parties observing it from the outside.
Do you think you've done what you needed to have done as an explorer? Clearly, you're not going to raise money to drill hundreds, if not thousands, of wells here. Do you feel you've been harshly judged in terms of recent performance, recent reactions?
I mean, the market is a harsh mistress, but it's always right in the long term. And we don't believe today's price is the long term, and that there will be rebounds as we deliver de-risking and news flow, as I've described in the weeks and months to come. I mean, things go too far up and they go too far down. That's the nature of the beast. But in the long run, they do. Price does discover degrees of truth, pretty regularly. So yeah, we think that rebound will happen through the various mechanisms that I've described. And we'll be judged by that prediction.
Right, you and your team, been at this a while. In terms of your track record experience, it's getting to this point. But is there anything that you would have done differently?
I think that there is a balance to be struck as a junior by the need to do things quickly and satisfy shareholder demands that you have a work program, versus could have been more measured and delayed work such that the interruptions that we described earlier in this discussion could have been more controlled. I mean, that's a hindsight question, because of course if we'd done it that way, everyone would have screamed, "Why aren't you doing things more quickly?" So as and when we do bring in a large partner, that then pace will be set in ways which are more measured. The farming deal that we strike will obviously try and accelerate things, and the success in doing so will be the perception of the incoming party as to what others might offer. But yeah, I think that would be the key lesson, is that balance between schedule and measuring, which is the eternal issue that small listed companies have to juggle with.
Yeah, time is money and all of that. Just one final thing. US elections just happened. Drill, baby, drill, or drill, whatever the quote is from Mr. Trump. But it suggests that America's going to get back to what they call fracking and sort of unconventional plays of their own, unconventional. So, what's the knock-on effect for countries like Australia to that story?
I think that the reality is that American oil and gas production, which is as highest ever under the current government, is a function not of what governments do at the federal level, it's a function of what the private sector wants to do and what certain key states like Texas facilitate. So the federal government's levers are limited. The pause that was put in place about a year ago by the Biden administration on new LNG plants will be lifted, but it would have been lifted anyway. That won't make much difference. Key thing from an Australian point of view is that there will be more LNG production on the east coast of America, primarily from the Gulf. But we're in the Pacific LNG market, and the costs of Atlantic LNG getting to the Pacific are fairly high. If you can produce more gas in the Pacific, it will be favored by the buyers there in Japan, Korea, China, and Vietnam, Cambodia, all these emerging nations, India in particular. So what's the Trump administration's effect on that? Well, firstly, I think West Coast Mexico LNG is probably doomed, because there'll be a massive trade war with Mexico. I think new LNG in West Coast Canada will probably suffer not quite as badly, but from similar aspects. I think China won't want to buy American LNG because they'll be in a huge trade war with America. I think Qatar will face risks of Iranian escalation, and then buyers will be wary of taking more Qatar gas. So you add all those things up, Australian LNG becomes very, very well placed to supply the specific markets. American Atlantic LNG will obviously focus on Europe and getting through the Panama Canal at high cost, but that's a significant cost disadvantage to Australia, both by distance and by those sort of canal fees, etc. So this is obviously fairly new. This time last week, we all thought it'd be a contested election, but a lot of analysis into this, I think, in the first instance, is shallow. Drill, baby, drill doesn't mean much. And then the geopolitical implications of trade wars will play itself out in LNG markets in very interesting ways, and I think very positive ways for Australia.
Interesting. We'll see. I'm excited to see how it actually does play out. It's like talk is cheap. Okay, Neil, I appreciate the update. So next steps, what am I looking for?
So we're looking for progress on farm out discussions on the conventional, which could be quick, versus the large play, which will be slower than retail shareholders would like, but reflective of the reality of big company timeframes. We'll continue to de-risk resources. We'll advise on the securing of the retention license. We'll continue to cooperate with neighbours, some of which are public, some of which are not public. We still have a Mongolian asset. We're working on various negotiations there with respect to farming down, selling out. And we'll advise the market of those as those progress. So still plenty to come. And as I say, we believe we've got a pretty good track record of delivering and doing deals in ways which add value for shareholders.